Let's turn to the market reaction to Powell's comments and retail sales here as Treasury yields are ticking higher as traders rethink bets on Fed rate cuts. Joining us now for more, we've got Chris Rupkey, who is the chief economist at Forward Bonds. Great to have you here with us this morning. So as you kind of look at the overall inputs into the economy right now and really start to think about how the Fed may also be positioning itself, what are some of your anticipations and the corollary to where the bond market may move as a result?
Well, it's interesting. I mean, they've given us a game plan. We've never had a schedule for rate cuts. Usually the rate cuts that we've had are, emergency type cuts in a recession or a pandemic. But this is the first time they've put out a forecast showing rates going down to 3.5% next year. But that's kind of being called into question right now. I'm a little worried when Fed Chair Powell says there's no hurry. It makes me think they're a little bit taken aback by the speed of the Trump administration hiring people and talking about what they're going to do in terms of fiscal stimulus, spending cuts, et cetera, tariffs. Maybe they're a little bit worried, Powell, even though it's too early to judge what is ultimately going to come out of the new administration.
Chris, what are your expectations for growth next year?
Well, that was interesting. Powell came up to my number. Well, he said yesterday that the economy right now is running 2.5%. So given the strength of retail sales today, there's no hesitation on the part of consumers right now. All this uncertainty, there's been hurricanes damaging, there's been strikes, the election uncertainty, as I said, nothing has slowed them down. In fact, right now, retail sales is running even faster after today's data. It's running 3.7%. A month ago, we thought it was only running 1.2%. That's in the fourth quarter. So what that means is the economy is probably going to run 2.5% this year, with GDP 3% in the fourth quarter. So that's important. Remember, they always say, watch the Fed forecasts. If the forecasts need to change and they get it wrong, then maybe policy is going to have to change or be different as well. And right now, the Federal Reserve is looking for only 2% growth, 2.0% growth in this year. And growth is running 2.5%, much stronger. So maybe that's part of the reason why he's saying they don't need to hurry.
I mean, Chris, what is part of that consumer resiliency? Is it people like me who say, all right, I can't buy a house right now, so I might as well just buy some new shoes. That'll make me feel good. And if ultimately the goal is for the Fed to pull off this soft landing, can that soft landing be orchestrated without or with the housing market staying the way that it is right now?
That reminds me of the before the Great Recession with Bernanke at the helm of the Fed. He continually said the weakness in the economy was confined just to the housing sector. And then, of course, everything blew up and we had the biggest recession since the Great Depression. Right now, similar. Housing is down in the dumps, especially existing home sales. New home sales have picked back up a little bit. But, because 10-year yields have moved back up, mortgage yields are not going to come back down to provide relief or a boost to housing sales. So, yeah, it's kind of an interesting time. The economy looks pretty strong. The only weakness is housing. And so far, that weakness hasn't even translated into people buying less furniture or appliances and things like that. I was really surprised that there is a bit of a services spending component in retail sales, which are mostly goods based. But, bar and restaurant sales were fairly strong, both in September and in October. So the public isn't staying at home. They're venturing out. There seems to be no fears about the outlook.
All right, Chris Rupkey, Forward Bonds, a chief economist. Thanks so much for joining us here this morning.